we're going to jump into my favorite topic, which is derivatives. And then Wednesday, we'll do the relative value question. And then next week, we'll have the team question on derivatives, and you would have seen the entire exam. I noticed students are doing a capitalized earnings. We're not doing that anymore. If that's in the video, just leave it out of your paper. So I used to do that one, but I don't do it anymore. It is interesting. It's not bad to have it in there, but you don't need it for the exam or for your paper. But I don't count off if you have it, but you don't need it. So, all right, let's talk derivatives. I'm a heavy derivative user. I was at UTSA. I think they're quite wonderful things. My risk management class, they had to do interest rate swaps, which are my favorite of all derivatives. So what is a derivative? And what can you do with the derivative? Either to speculate, to invest, to hedge. They do all kinds of things. So in your class notes, it says a derivative is a security. They're not all securities. So swaps are not securities, forwards are not securities, but a lot of them are. A security is something that you can trade on organized exchange. So I should have said it's security / asset. It derives its value from something else, and that something else can be all kinds of things. It can be another security, it can be an index, a benchmark. It can be, oh my word, there's just almost no limit. It can be weather related. There's a lot of things there. So the thing that it gets its value from is called the underlying. So the underlying is probably what you're focused on with a derivative. Good example, we talk about options. You don't buy an option because you think the option's mispriced. You buy an option because you think the underlying's mispriced. So the underlying, so if you're buying a stock call option on the Apple, the call option is the derivative. Apple stock is the underlying. So the derivative is going to be based off of Apple stock. And it's really simple. There's only two derivatives. There's options and futures, and that's it. That makes it really easy. All right, so options, that includes swaptions, includes your auto insurance. Did you know your auto insurance is a put option? You buy, what do they call when you pay your auto insurance? What do they call that? Is a premium? What's an option price called? A premium, all right. So to buy auto, what did you buy in auto insurance? It's a put option. It gives you the right to sell your car back to the insurance company at cash value. When would you do that? When you wreck it, right? So yeah, insurance is an option. The right to prepay a mortgage. We talked about that with mortgage-backed securities. Your right to refinance your mortgage is an option that you get when you do the option. So you're paying more in interest in order to get that option. So an option gives you the right to do something, but doesn't force you to do anything. That's the key with an option. It's the right to buy something in the future, sell something at the future at some stated price. For stock options, it's the price of the stock. So you might have the right to buy Apple for $100 or sell Apple for $150 at some stated price, and then some time period, 3 months from now, 4 months from now. But it's a right. It's not an obligation. That's why it's called an option. A future includes swaps and forwards. So realize swaptions are options. Swaps are like futures. Futures and forwards and futures and swaps. I don't think of futures and swaps as the same thing, but they really are. When I took the CFA exam part 3, we had an entire book we had to read. And the entire book, the only purpose for it was to prove that futures and swaps were the exact same economic transaction. And I got into that book. I loved it. I couldn't replicate any of that today because I've forgotten most of it. But that book convinced me. I don't know how it convinced me because I haven't read it in 25 years, but I'm just assuming that I would still agree with it. But a future, swap, or forward, it obligates you to do something. You have to do something. So when you get into it, you're stuck. You still call it, it's still related to the underlying. You can do an option on the S&P 500. You can do futures on the S&P 500. If you do options, you pay the premium, and you can just give up. You can stop. You just lose your premium. You do the futures, then if the S&P goes up or down, You're going to be having gains or losses until you get out of the future. You have to close it down. So a right versus an obligation, and then there's several in between. And the underlines where we got really creative in markets. There's a book I love and I can't find it, but it talked about how the CBOE and other entities create new derivatives. It's a really, really fascinating book. If I ever find it, I'll put it on my reading list. I thought it was a great, great book. The guy who wrote it actually worked for the CBOE where they created new options like CPI options and other things. Really interesting stuff, but I can't find the book. But that's it. Options and futures. Some key terminology. The notional value can be really, really difficult to understand. I don't know if this link works. It does. Let's see if it will bring it up. Yeah. So yeah, we'll get into that one. So the notional amount is your exposure that you're getting on the derivative. It is not the market value of the derivative. It's not the price of the derivative. It's your exposure. So futures, when you buy a future, when you buy a swap, you buy a forward, what's the market value when you buy it? Anybody know? What's the entry price for a future, forward, or swap? They all have the same entry price. What do you think it's going to be? 0, right? I learned that on the swaps, right? You enter a swap, the market value is 0. When I did my first swap for a few $billion at USAA, the accountant's like, did you do something? No cash moved. There was no price. I say, yeah, we did something. You better put it on the books because tomorrow you're going to have a value to that thing as the market value changes. But those go in at 0. That doesn't mean the notional value is 0. The notional value is what your exposure is. So if you buy futures on the S&P 500 at $1 million, the market value is 0 when you enter that, but your exposure is $1 million. So how your futures is going to move is going to depend on how the S&P moves times $1 million. So if you buy a futures, $1 million of futures in the S&P, and the S&P goes up 10%, you're going to make $100,000 on $1 million. If you have 10 million, you make $1 million. So that notional is pretty important because don't go in, oh, the market value is 0, so it's not much exposure. No, if you have 10 million versus $1 million notional, you're going to have a 10%, the 10 times bigger move. So let's look at this. The press loves notional value because the numbers are just massive. So let's look at this and compare. I don't know if they update this very often. They haven't. It's been 5 years, but it still makes the point. So if you owned all the silver in the world, it'd be about $44 billion. Cryptocurrency at this time, 244 billion. Military spending, U.S. budget deficit, coins and banknotes, the Fed's balance sheet, the number of billionaires, that's about $8 trillion. Gold is probably much higher today, but at that time it was $11 trillion. All the stocks in the Fortune 500 is, doesn't show us the number at this time, but these numbers are much higher today. All stock markets, 89 trillion, almost 90 trillion. The money supply, 96 trillion. Global debt, did y'all know there's more bonds than there are stocks, market value wise? That is, I don't see the number again. Oh, 253 trillion. Real estate, did y'all know real estate's bigger than stocks and bonds? 81 trillion. And then you can break it up in global wealth, 361 trillion. And then derivatives. Market value is only 12 trillion. Notional, they don't know. It's somewhere between 559 trillion, much larger than anything else. But it could be as big as 1 quadrillion. Look at that. So when you look at the notional for derivatives, it's a massive, massive number. Larger than almost everything else put together. But it's a very deceptive number. Because if I buy a futures for $1 million notional, and you sell a future for $1 million, that's counted as 2 million. So there's a lot of double counting going on. But it's a massive, massive number. So The notional is what's going to tell you what your gain or loss is. So it's really, really important you know what that is. The underlying can be a specific stock or now an ETF. This is what's gotten really, we talked about a few classes ago, ETFs, exchange traded funds have options a lot of times. I've done options on bond ETFs. I've done options on bond ETFs that were 2 times the treasury. So that I can get as much kind of leverage as I can get it. You can do it on indices. You can do it on commodities. You can do it on interest rates. You got to be careful with interest rates because whether you're long or short is you got to think about how bonds move. So if you're long on a bond futures, you're betting on interest rates falling because bond prices go up and rates fall. So you got to be real careful you're going the right direction. They've tried derivatives on inflation. They haven't worked too well, but they've tried that. You can definitely do derivatives on currencies. That one's really, that may be the largest one out there. You can do it on weather. You can do it on catastrophes, on life insurance. There's social impact bonds. There's all kind of things that we've gotten. I don't know about options and futures on cryptocurrency. I'm not sure. I don't follow cryptocurrencies. You could certainly do probably derivatives on cryptocurrency ETFs. It's just almost no limit. It's pretty amazing. We talk in my property and casualty class about catastrophe-based bonds. I mean, it's pretty amazing. But that's the underlying and the notional value are really key numbers for you to understand. Your risk comes from the underlying times how much notional value you have. There's several places you can go to. CBOE.com is a great site. Highly recommend it. They have an educational key in there. You can do all kinds of things. They've been a research library, so really good. They want you to buy options because that's what they do. They're the ones that, you know, trade these things, and so they give you all kinds of free stuff. They have option basics, some tools. They have some pricing tools in here that you can do. They have an option calculator, which is pretty cool. You're not going to use their calculator to figure out if an option is mispriced, though. You're probably going to rely somewhat on the market. So with options, you're not buying the option because you think it's mispriced. You're looking at the underlying and making your trade. They've got a glossary, that all kinds of stuff. So it's a really good website. The Khan Academy, the guy amazes me. I'm like, what topic hasn't he done? And he does a lot of them himself. So it's a really smart guy. I've used the Khan Academy. I like his video because they're like 5-10 minutes long. So you're not like committing yourself too much. Amazon has some books out there that I do love this book, Trading Corporate on Corporate Earnings News. It's a really good book. It's short and really covers what we did in paper 2 on earnings announcements and how can you trade options around that. They typically do straddles. The Options Guide is a good website. There are podcasts out there on options. There's all kinds of things you can do on options and futures. They're all over the place. So there's plenty of places you can go to learn more. So let's talk. Why did I have? Oh, all right. We have a little more time, so I think I'm gonna. Yeah, let's talk futures first. Your exam question is on options. We'll do futures first. I'm not a futures guy. I'm a swaps guy. I love swaps. I think they're magical. But futures are good as well. I've never traded futures. I've only traded swaps. They're just make more sense to me. So if you do a future, you're obligated to buy or sell something in the future. You're obligated to buy something in the future. You're long, that means you're bullish. You're expecting that asset price to go up. If you're obligated to sell something, you're bearish. You're shorting that security. So if you think the S&P is going to fall, you'd want to sell S&P futures. If you think it's going to rise, you want to buy S&P futures. We talked about FinViz before. They give a pretty good list of all the futures out there. You can look at what really trades really well. Bloomberg has a good list as well. So let's use an example of a barrel of oil. Barrel of oil is what, about 60 bucks. Here I have $100, so I wrote this some time ago. You have the spot price and the future price. So the spot price is what it would cost you to buy a barrel of oil today. Have it show up to your on your driveway. I don't know if Amazon delivers barrels of oil, but if you bought a barrel of oil, it'd be $100. Or you could do a 3-month future. The 3-month future says in 3 months, you have to pay $102. Well, that doesn't seem fair. You just buy it today, right? But if you bought the oil today, what would you have to do? Let's say you bought 1,000 barrels of oil. What would you have to do? You have to store it. Is that going to be free? That's going to cost you some money. What's the other thing if you buy the oil today versus in 3 months? What's the other advantage of waiting for 3 months? Would you rather spend money today or in 3 months? Would you rather not spend the day? You can invest it. So you've got storage costs and you got the time value money. So that's what the $2 is for. That's called cost of carry. Let's say it costs you $1.50 per barrel to store the oil and 50 cents in lost interest earnings if you bought the oil today. So you should be indifferent. If you buy the oil today, $100, it's going to cost you $1.50 to store it and 50 cents you're going to lose in interest. Or you can just not do it today, wait 3 months, you have to pay 102, you should be indifferent. Those two should be the same. And that's what cost to carry is. I've heard people say the spot price is 100 and the future price is 102, so the market expects oil prices to go up. That's not true. So let me just rationally think about it. If the market thinks oil prices are going to go up in 3 months, what would oil prices do today? The whole market thinks oil prices are going to rise in 3 months. What would oil prices do? They go up today. Right? It's not like everybody said, oh man, oil prices are going up, but they're $100 today. You know, that's not the way it works. So you can't think of futures prices as a forecast, at least not in oil. More perishable goods, maybe, that you can't store as well, possibly with oranges or something. But generally, the futures price is really talking about time value money and cost of carry. But there are some strange phenomena out there. There's things called backwardation. We're going to talk about in my risk management class probably tonight. But contango is the normal. Contango is when the spot price is lower than the futures price, because contango means you have the spot price plus storage plus the time value money. The future price should be higher. But there are times where that's not true. We have backwardation, where the future price is actually lower than the spot price. And you say, wow, that sets up some arbitrage opportunity. What arbitrage opportunity could you do? Doesn't quite work. Because the arbitrage this, you'd have to sell oil, you'd have to short oil today for $100 and buy the future at 98. That'd be great. I'm going to sell 1,000 barrels of oil today, in our future contract to buy them back at 98. When's the last time you shorted a barrel of oil? You'll do that very often. You sell oil you don't own. You can short stocks. That's pretty easy to do. Well, when's the last time you shorted a barrel of oil? I bet you've never done it. It's really hard to short a physical good like that. So this would be really impossible for you to arbitrage. But backwardation is there, and there's actually a correlation between backwardation and where oil prices are going. So there is some predictability to it. How often are, and I don't know the answer to this because I'm not an oil trader. How often are oil futures in backwardation? See if anything comes up. Why is oil in backwardation? Oil prices are in backwardation. We'll explain. I'm not seeing a percentage. It's not the majority, but it is not that uncommon. It does happen. So there you go. I mean, if you want to learn about it, there it is, backwardation. If you trade oil, so some of these, you could make this your entire career to be a oil futures trader, be your entire life. You might do oil and natural gas and a few other things. there's something called the roll risk, which is if you do a 3-month option of futures, but at the end of 3 months, you want to roll it another 3 months. That roll risk is really important. That's where backwardation can be extremely important. I talked to an oil future trader once, and I asked him, what do you think about oil prices? Where are they going? He said, oh, I don't really know anything about that. It's like, well, this is your career. But he doesn't know oil prices. He knows oil futures trading. He knows backwardation. He knows contango. He knows what that means. He knows how to manage oil risk with the roll risk. But I thought, man, I thought for sure you'd have an opinion on oil prices. Like, no, I don't really cover that up much. So it's a very technical, very mathematical field. You probably would, within 3 or 4 months, be talking in ways that your friends would have a clue what you're talking about. You really, really technical language, and you wouldn't realize you were talking over everybody's head because it's pretty complex stuff. It's not an area I've gotten too much into, but it's pretty important. Could be your career. Not just on oil, but you could certainly specialize in agriculture or in metals and really understand this market. And they would pay you quite a bit because it's pretty technical. I'm not saying go out and seek this career, but if you're sitting at your desk and they offer it to you, I would take it. This would probably be a pretty lucrative career. I kind of like these careers where they're really, really highly specialized. You just become so knowledgeable, and then you just deep dive. You just learn everything you can. And it'd be around 50 years from now, so you'd be pretty set. Probably really, really high salaries for the rest of your life. But you're not going to interview for a job like this because there won't be enough to hire you, and they're not going to hire you anyway. So these kind of jobs, when they come up, you jump at it, you go take it because you're gonna make a lot of money. It's gonna be a lot of fun. I give you an example here how the trade would actually work. Pretty much showing you if the futures price covers cost of carry pretty well, you're indifferent between buying the oil today or buying the future. You come out exactly the same. So I won't go through that math, but that's essentially what that's showing you. So really the futures market is just another way to enter the cash market. You have the huge advantage that you're not out of cash today. You're just making a promise in the future. If you actually need the oil, but you need it in 3 months, rather than doing the cash market, you can just see the futures market, but you can lock in your price today. So if you're worried about oil prices falling, you can certainly short it, sell the futures. If you're worried about oil prices rising, you can buy the futures, lock in a price. That's the case we're going to talk about in a risk management class, where they use the oil futures to lock in a gain. And it blew up on them, not because futures don't work, it's because they didn't handle the communication very well. So that's a huge advantage of the futures market. It's very, very liquid. It trades very, very quickly. Its liquidity can be a problem in 2008 because futures are so liquid. Sometimes they were the first thing to go. Matt Freund that I worked with, he used to say, in a crisis, you don't sell what you should, you sell what you can. And futures are the easiest thing to sell. So sometimes their prices just got completely out of whack, everything else. There were in 2008, there were some, if you had money to spend, there were some pretty amazing transactions you could have done at the end of 2008 because markets got out of sync. Now, what's the difference between a future and a forward? A future is traded in standardized contracts over established exchanges, very, very, very liquid, very little counterparty risk. You're not really worried about the exchange going under. So extremely liquid, very little default risk or counterparty risk. Forwards, including swaps, these are over the counter. They're very illiquid. They're between sophisticated buyers and sellers, and you pick up counterparty risk. The bank that you're doing the transaction with, that they go under, you're in a lot of trouble. I talked about that in my risk management class in 2008. We had swaps with JP Morgan and Morgan Stanley. I wasn't worried about JP Morgan, highly worried about Morgan Stanley. So, they owed us like 500 million bucks. And that sounds really good unless Morgan Stanley goes under and then they don't give us anything. You got to really understand the risk. So here you have counterparty risk. How do you handle this? Well, a big part of it's handled through setting up collateral. They got to set aside assets. But if they owe you 100 million bucks, they set up $102 million in collateral, but then markets go crazy, and then tomorrow they owe you 300 million bucks and they went insolvent. You may only have 102 million in collateral. We're going to lose the other. And it's kind of embarrassing going to the boss and say, hey, we hedged this risk. Good news is Morgan Stanley owes us 300 million bucks, and that covers our risk. Bad news is they're insolvent. They only can give us 100 million. That's not a good way to make your boss's day. So forwards, including swaps. So I did a lot of swaps. You're really worried about the firm you're dealing with because in 2008, you had dealers like Lehman Brothers doing the swaps and AIG and others. So, Lehman Brothers went under and their swaps would have been just a disaster. Most of these contracts are settled in cash, not in the actual goods. So if you do oil futures, you probably don't want a barrel of oil showing up at your front driveway. So what you'll probably do the day before the contract expires, you'll probably get out of the contract. How do you get out of contract? Well, if you bought $1 million of futures, you just sell $1 million of futures and now you're out, you're square. And it will move exactly with the market. Make sure you know exactly when the thing ends so that you don't end up getting delivery of the contract. They probably won't deliver it to your house, but they're going to deliver it somewhere, and who knows what that means. I would never risk that. So get out of the contract the day before expiration. Okay, now we go to options. So we're not going to do as much on options. I mean, on futures, we're going to do options. We're going to spend more time on options. Brian, can't remember his last name. He teaches the speculative markets classes. Are they offering that in the fall? Y'all know. So you got the speculative markets class. Brian, whose last name I can't remember, he teaches it. He'll spend probably half the time on futures, half the time on options. It's good to take one of those classes. They'll cover the binomial models, the Black-Scholes models. You probably won't memorize those and use them the rest of your life, but it is good to get some exposure to those. They'll talk about all the Greeks. We'll talk the Greeks really high level. I'd encourage you to take some basic options classes, like kind of what we're doing here, but go out and just start trying some strategies out. We finally found the function in Bloomberg that allows you to set up option strategies and test them. You can do like 10 legs to a transaction. Just try out different strategies. Go read about different strategies, see how they work. We'll talk about the most common ones here. But we're going to talk about options that give you the right to buy something or the right to sell something in the future at some price. The right to buy something is called a call. The right to sell something is called a put. The future date is called the expiration date. The stated price is called the strike price. Now, does the option to do something have value? We'll look at Apple. Apple stock has been as high as 250, 265. He got it low as 175. So between, say, 170 and 250, let's look at its options. So it's currently trading at 210. Well, go out to July. So it's currently trading at 210. If I said between now and July 18th, you have the right to buy Apple for 230 bucks. You can buy for 210 now. I'll give you the right to buy for 230. Would that have any value to you? I mean, it doesn't sound very good, does it? But what does the market say? Is that a call option or a put option? You have the right to buy Apple for 230 bucks between now and July 18th. That's a call option. Is it in the money or out of the money? It's out of the money. How do you know it's out of the money? Because you wouldn't execute today, right? You wouldn't buy Apple for 230 today. You can buy for 210. So it's out of the money. So does that mean it's worthless? Well, let's look and see. Here's 230 up. There's the price. $4.90. You'd have to pay $4.90 for the right to buy Apple for $230. You can buy for 210 today. What if Apple goes to 230 bucks? Was this option a good trade? Well, think about it though. If it went to 230, what would you make on the option? Yeah, how much would you lose? $4 and how high does the price need to go for you to break even? 234.90. At 234.90, you start making money. All right. What happens if the strike price goes higher? What happens to your option premium? It's a lot cheaper. Why is it cheaper? Because you're much less likely to hit 250 than you are to hit 230, which means what? What's really important to this? How volatile their stock is. Remember when we're talking about mortgage-backed securities, the more volatile interest rates are, the more value that option is, and the more horrible it is for the investor. So as you get further out of the money, the right to buy call option gets less valuable. What if I give you more time? So 230, our premium is 490. What if I give you the right to do that all the way out to December? Would that be more valuable or less valuable? More time, is that good for you or bad for you? Be good for you, wouldn't it? So let's look at 230. And sure enough, what did the premium do? It goes from 490 to 1335. Pretty material, isn't it? That's pretty huge. All right, so does an option have value even if it's out of the money? Yeah, it does. Does it always have? What if I give you the right to buy Apple for $2,500 between now and December? Does that have value? I mean, it's possible. You really think Apple could go from 3 trillion to what it would be 10, 20 trillion? Pretty unlikely. But it wouldn't be zero. It might be 0.00000000001 or something. It'd be really, really small. But there's some value. Something crazy could happen. So the nice thing about options is while you have a large probability of loss, you have a small probability of a huge gain. Is very skewed. I've had options up 40,000% between Friday and Monday. I mean, these things can move really, really dramatically. So very, very skewed distribution. So an option is in the money, out of money, at the money. So when the current price is greater than the strike price, so Apple's at 210 and the strike is 200, then the call is in the money. That means it has intrinsic value. We'll talk about intrinsic value. So the strike is 200 and Apple's currently trading for 210. Well, that's a really good call option. You get to buy Apple for $200 and it's currently trading for 210. That'd be in the money. It's the exact opposite on put options. The current price is higher than the strike price. The put option is out of the money. If the strike price is higher than the current price, that's what we just did, 230 versus 210, then it's out of the money on the call side. The strike price is higher than the current price, then the put option is in the money. If you're at the money, if the two are the same, you're at the money, which is pretty rare because when is Apple going to be exactly $230, 0.00? It's not going to, it's pretty rare to be exactly right at the money. You might be today, they're pretty close to at the money at 210, but they're 210.14. So if you look at a 210 strike, notice that it's in the blue, that means it's out of the money. But look at that premium. My, it's massive, isn't it? So that's in the money, and then 215 is out of the money. And then exact opposite on the put option, 210 is slightly in the money, 215 is out of the money. So you got your puts down here, your calls up there. Look how many contracts you have. And there's even a contract for $5. So you can buy Apple for $5. It's trading for 210. What's it going to cost you to enter that transaction? Going to cost you $206, right? Which is essentially what it's going to cost you to buy the stock anyway. So yeah, I mean, there's not much there. I don't know why there's a $5 strike on Apple. That's kind of bizarre. They show you how many people have the open interest. You can see there's a lot of open interest at 100. A lot of open interest at 150. A lot of open interest at 180. I think these open interest numbers are kind of interesting because they might set up some corridors for the stock price, because obviously those are really important numbers. I've done option transactions where this was me. It makes me a little nervous. Like, okay, I got 6 contracts. Oh, there's 6 contracts. Makes me a little nervous. That's when you're real careful to look at the bid ask and make sure it's not so wide. We'll talk about bid ask. That's how you can kind of tell if you're maybe getting ripped off. You got to be really, really careful. So you have the last price and you have the bid and the ask. The ask is what you have to pay. The bid is what you receive. So ask is what you pay if you buy the option. The bid is what you get if you sell the option. At USAA, we didn't look at the last price. You can see how far the last price is from the bid ask. And I noticed this, we had options in one of my mutual funds and I called the accountants and said, man, your valuation's way off. There's something wrong. They were using last price. I said, you can't use last price. I wasn't doing something this crazy, but you can get some pretty crazy last prices if I can find one. But here's a good example, 1172, but the bid ask is much lower than that. Well, this might be a trade that happened like at 2 o'clock. The last trade may be at 2 o'clock, but between 2 o'clock and 3 o'clock, a lot of stuff happened. And so with options, you got to use the bid ask because the last price, look here, another example. The last price is a good 35 cents off from the ask price. That's a lot. That's pretty material. And so that's what I noticed. They use the last price. And so I told them, stop using last price, use the last midpoint between bid and ask, because that's going to be much more reliable numbers. These are updated more frequently because I could tell my portfolio was just mispriced. Any questions up to there? The best way to learn this is to just start doing it. So let's talk about first, what determines the value of an option? And my class went all over the place, but we finally decided on Texas video. Depends on whether you like baseball or bowling. If you like bowling, it's Texas video. If it's baseball, I don't know how you tickets video, I guess. So just pretend like you're a bowler. Y'all probably never go bowling. That's probably something your uncles and grandparents do, but anyway. Right, so the strike price, I use an X for that, for the word strike. In bowling, if you get a strike, it's an X. In baseball, if you get a strike, what is it? It's a K. All right, so you can do TKS vid or TXS videos. I use an X. I've seen in the option pricing model, I think they use a K. Let's see. Yeah, they use a K. So, and I don't know if they use a K or Wikipedia is using a K, one or the other. Here's the option pricing model. I used to have this formula memorized for the CFA exam. I couldn't tell it to you today. It's actually a fairly simple formula if you really look at it. It's using pretty basic statistics. So the first thing that's going to impact it is the strike price. So we looked at Apple, the stock was trading for 210. We did a strike of 230. So for a call option, the higher the strike price, the less valuable the call option is. We saw that with Apple. As you look at 230, it was 490. And as we went closer to 210, it went higher and higher and higher. It went further away from 210, it got lower and lower and lower. For a put option, the higher the strike price, the more valuable, because the strike price is the price you get to sell it at, the put option. So obviously you have more value, you can sell it higher. The call option has more value if you can buy it lower. So on strike price, it goes in opposite directions. For time, that's the T. You notice these aren't in order, and they're in order how we think about it. So time, the T of Texas, that's the maturity date. The more time you have, the more valuable the option is, whether it's a call or a put option, doesn't matter. All right. We're going to talk about time decay. You're going to calculate time decay on the exam. It's an important concept. So the more time, the more value the option almost all the time. In 2008, for the first time and only time in my entire career, there were 6-month options that were cheaper than 3-month options. And I felt like quitting my job and just doing a bunch of trades, but I don't know if it would work because I might have gotten killed on the bid ask, but it was like, you mean I can buy an option in 6 months for $4 and sell one in 3 months for $10 or $6? I mean, it's like, there's no way you can lose on that transaction. But yeah, I couldn't do it if I was still working at USA. I would have had to quit. But 99.9999% of the time, more time means more valuable. And we just saw that, right? We went from $4.90 to $13. Huge impact. So the time decay is the difference between the option price and the intrinsic value. So let's tackle it now. This is real high level. So what is the intrinsic value? So let's look, do I have call options here? So let's look here. You have the right to buy option for 200, buy Apple for $200. It's currently trading for 210. What's the value of that? It's like $10, right? That's worth $10 to you. You can buy Apple for 200, it's trading for 210. That's the intrinsic value. What's the intrinsic value if you can buy Apple for 220 and it's currently trading for 220, 210? There's no value to that. You wouldn't do that trade. So if Apple's option is out of the money at 220, the intrinsic value is 0. If Apple is in the money at $200 strike, then the intrinsic value is the difference between the current stock price and the strike price, 210 minus 200. That's the intrinsic value. The time value is the option price minus the intrinsic value, which means if you're out of the money, 100% of this premium is time value. There is no intrinsic value. So the time value of this option is $15.50. But what about on this 200? Some of the option premium is time value, some is intrinsic value. We said the intrinsic value was $10, so how much is the time value? $19.10. What is that time value going to do over time? It's going to decay. Decay to what? At expiration, what do you think the time value is going to be? It's going to be 0. Why? Because when this thing expires, you can buy Apple for $200. It's trading for 210. It's worth $10. All right. So time value is going to be decay to 0. Same thing up here. You have the right to buy Apple for $250. At expiration, it's trading for $2. What do you think this option is going to be worth? You can buy for $250. It's currently trading for $200. It can be 0, right? That time value is going to go to 0 over time. That's called time decay. And so on the exam, you'll have to calculate the time value of the option. You have to get the intrinsic. We'll talk about the intrinsic value. We're going to calculate intrinsic value like 50, 60, 100 times. I don't know how many times. We're going to do it a bunch of times. All right. The next one is S. Now, I'm using X for the strike. Don't use S for the strike. S is for this underlying price. Think of that as the stock price. S is the underlying. Remember, for strike and the underlying, they go in opposite directions. The higher the price of the underlying, the more value the call option has. The higher the price of the underlying, the less value the put option has. The exact opposite of the strike. All right, so I have the right to buy Apple for $200. Apple's price goes to $250. That option is going to be worth a lot more money. And if I have the right to buy Apple for $200 and its price falls to $190. So if the underlying price goes up, the call value is worth more, and the value goes up, the put option has less value. So that's really important. Strike and underlying stock, that's the place where options and puts and calls go in opposite directions. Now let's do the last 3. What do y'all think V stands for? I mentioned it just a second ago. Underlying if you want to do, but we use S. I think, I'm pretty sure Black-Scholes uses S. So yeah, I don't know why it's not you. That probably would have made sense. You couldn't get Texas video out of that though, so it might not. Tux, but it'd be, no, it wouldn't be. Yeah, it would be. You could use Tux vid. That might have worked, but they didn't have creative acronym people back then. So yeah, they use S for the underlying. So just think S for underlying. Okay, what does V stand for? Any guesses? Volatility of what? The underlying, the volatility of Apple stock. All right. And what specific volatility? Usually what we expect over the next 3 months. How volatile will it be, but really over the time that the option is in place. So volatility of the underlying, this is the one that you don't know when you buy the option. You know how much time there is, you know what the strike is, you know what the underlying stock price is, you know interest rates, you know what dividends they're probably going to pay. So volatility is the one big unknown. If you're going to bet on option pricing, that's where you're going to bet. So that book I talked about, trading on corporate earnings news, that's a straddle strategy. You really are betting on your view of volatility. So what happens to volatility of stocks when they announce earnings? It's gonna be really volatile. So you have to trade, you're really trading on volatility. They're volatility trades. So that's the one unknown. The nice thing here, just like with time, the more volatility, the more valuable the option is, whether it's a put or a call. Because the more volatility, the more likely you're going to be in the money and have a good trade. All right. Notice how this contradicts the capital asset pricing model. So if you look at the history of the option pricing model with Black-Scholes, they started with the capital asset pricing model to try to figure out how to price options. They weren't trying to figure out how to price options for option traders. They're trying to figure out what option prices option traders were getting. So it's not like the option traders didn't know what they're doing and Black-Scholes had to come along. Black-Scholes are trying to figure out what the option traders already knew. They had to come with a formula with it for it. And the first formula they used is CAPM. Well, we know with CAPM, if something's more risky, you get a lower price, right? If you increase the beta for your stock, you're going to get a lower stock price. With options, the exact opposite. The more volatility you have, the higher the option. So that's why they can't use CAPM, because it's the exact opposite. I actually think this is the two worlds of finance. You have the CAPM world and you have the option world. CAPM world is discounted cash flows, less risky, lower discount rate, more value. The option world is very, very different. You want volatility. Now, why is that important? Well, if you're buying Walmart stock, you're just going to use CAPM. But if you're valuing some startup biomed firm, I don't know, some new drug company that hardly have any revenues, you're not going to use CAPM. That's an option. There's probably 96% chance they're going to go out of business. You can lose all your money. There's a 4% chance they become $1 billion stock and you make a fortune. You're not going to use CAPM. CAPM doesn't work well with that. You're going to using option type of theories, and you actually want more volatility. Because chances are you're not going to make any money. But boy, you want a chance that if you do make money, you want it to be a massive amount. So you want a lot of volatility. So just be aware out there. There are places where CAPM, a lot of places, CAPM makes a lot of sense. But if you're in an option analysis and you're using CAPM, you're going to make a really bad decision. I remember I had some graduate students making presentations on some startups they wanted to present. And one of the panelists asked, well, what's the value for this company? And the student gave the perfect answer. It's like, well, I don't know. Why is that? Because the panelist was asking for a CAPM answer on a startup company. And the student was right. Yeah, it's more than likely it's worthless. But there's a 5% chance it's worth billions of dollars. Doing CAPM and I get an answer of 20 million, does that help you? Something that's worth either 0 or 50 billion, and me tell you, well, 20 million is the average number. That's a useless number for you. That's not going to help you. So make sure you know which world you are in. There are times where you don't use what you're doing on papers 3 and 4. You don't do that. It doesn't make sense for your firm. We mentioned Dutch Brothers. Is Dutch Brothers more a CAPM firm or is it more a volatility kind of play? And how you know is how uncertain you are in their business. So Dutch Brothers is probably a CAPM. But you might have, well, Disney could almost, how could Disney be an option pricing one? What could Disney do that would just radically change the firm overnight? A new Toy Story movie? Y'all don't even know what Toy Story is. Some new Pixar Toy Story movie that suddenly people are crowding the movie theaters for. Exxon probably wouldn't work, but Exxon, some new oil field that they find. So if you have a firm that they have something out there that if it happens, it's massive, especially biomedical firm, it might be 100% option pricing. Where if it works, it's huge. If it doesn't work, it doesn't work. But you still buy it, right? Because if you buy 20 firms like that and 19 of them go insolvent and one of them's the next Microsoft, you're still going to make a fortune. So that's the option pricing world. There's a lot of stocks that it's all 100% cap in, like Walmart. There's nothing Walmart can do that's just going to be so massive they're going to suddenly become twice as valuable.
So the reason we can't do a CAPM model on options is because it doesn't account for volatility.
Well, you're actually buying volatility. You want volatility. If you're doing Walmart, you don't want volatility. Wow, there's a 40% chance they're going to go out of business, but no, you don't want that. There are times where you do both. So there are firms where 90% of your valuation is cap in and 10% is optionality because they have something in their business as huge optionality. That might be gaming for Netflix. What if Netflix gets into the gaming world? Will that work out? It could. Could that be huge for them? Could be huge. What about driverless cars for Uber or for Tesla? You know, Tesla's pushing, Musk is really pushing the robotic taxis, robo taxis. That you probably can't value that. It's either going to work or it's not. And if it works, it could be huge. If it doesn't, that's more optionality. So you might have to value Tesla or Uber. Uber might be the better example. You might have to value Uber as a rideshare program, but then the driverless car part of it might be huge. I actually like Tesla's business model better than Uber's on the driverless car, mainly because Uber doesn't own any assets. And if they're going to do driverless cars, are they going to suddenly start buying cars? Or are they going to start renting out your car that you buy that's driverless? But that's that optionality side of it. So if you watch the Motorins class and New York Stern, he calls it the contingent claim kind of valuation, where he'll break stocks up between the cap in part and the optionality part. And you value those two parts separately. What you'll find is firms that have the optionality side always look expensive. And the reason they look expensive is the optionality side essentially goes to zero because there's a big chance it doesn't work out. But would you pay an extra $10 for a $200 stock, and that $10 could turn into billions or trillions? Yeah, there's a good chance it won't work at all, but my word, you got that huge upside. And so stocks that have a lot of optionality, it can be in just one place of the business. It's a huge volatile optionality. They're going to look expensive because that optionality has value. And you can actually value that. We don't cover it undergraduate. It's a pretty complex part. I don't know if I can find this. He covers it in some of his classes. If you're interested in it, not only does he cover it in his class, but he gives you an Excel model where you can actually do the analysis and do the two pieces if you want to. We won't cover it in this class, but just remember, I mean, it's really, really important components for certain stocks. All right, the next one is interest rates. This one can get a little confusing. It's a little more important now that interest rates are higher. 5 years ago, it was really unimportant because interest rates were practically zero. But essentially, if you think about a call option, you could buy the stock today and you're out the money. Or you do the call option, you don't have to buy the stock for 3 months. So it's, again, the time value of money aspect of it. And so higher interest rates make call options more valuable because you don't have to buy it today, you get to delay it. And it decreases the put option because you don't get to sell it today, you have to sell it in the future. But I'm not that interested in that you memorize that, but just think about that. It's that time value of money. The call option keeps you from having to spend the money today. The put option, you don't get your cash today. So, and then dividends, we'll kind of ignore those, but dividends, dividends, when they're paid, we talked about that earlier. When a stock pays a dividend or X date, the stock price falls by the dividend. Well, that obviously going to hurt a call option. It's going to help a put option because call option wants higher prices. You pay dividend, brings it down. So dividends are important. Usually dividends aren't a surprise, and so you can handle that pretty well. But if you look at this option calculator. They ask for the time, the expiration date, the strike price, your volatility. They ask for interest rates, and they ask for the dividend. Or you can do a particular stock. I wouldn't do that, but we can do. It's not letting me do it. They changed their website, so it makes it a little tough. But anyway, if you put in a stock, it will bring in all those assumptions, and you can change them if you want to change them. So, and one thing you'll see, y'all remember the VIX. So what is the VIX? The VIX, because remember, we know all of these inputs except for volatility. What the VIX says, given the option price on the S&P 500, what does the volatility have to be to get you that price? Because we know all these other things. So it's the implied volatility of the next 3 months on the S&P 500. So that's why the VIX is kind of our gauge of volatility, because it's a future number. It's not looking in the past. It's a future number. It's highly correlated to the last 90 days, but it is a future number. All right, so Texas video. The Greeks, so the Bloomberg terminal does a really good job with the Greeks. So Delta, what Delta is asking is, how does my option price change given a percentage change in the underlying? So if Apple stock goes up 10%, how much will the call option on Apple price go up? A call on Apple. And you can somewhat see that here, wherever we were. Well, did I shut down? There we go. So Apple's price today went up 0.41%. The call option went up 5%, or went down 5%. That's interesting. It went down 5%. That could be time decay. I don't know what option I'm in. Let's go back to a more reasonable date. So the stock price went up 0.4%, but the option price went up 4%. That's your delta, that percentage change. Obviously, options are going to be much more volatile than the underlying. On the put options, the option went up, the put options fell. So that's somewhat what you're talking about with the delta. With put options, your delta is going to be the exact opposite. Your gamma is a lot like convexity. So think of delta being like duration and gamma being like convexity. Delta is how, you remember with duration, how does the bond price move when interest rates move? Convexity is how does duration change as interest rates change? So delta is like duration, gamma is like convexity. It's the change in the change. Gamma can be extremely important. We're going to talk about collar strategies. You got to be real careful on gamma, because you think you got a 20% delta, 30% delta, but that might fall to zero if the stock price gets to a certain point, and you may not. You want to know how delta is changing as the stock price changes. Theta is pretty simple because it starts with a T. Theta is simply that time decay. How much is the option price going to fall just because you moved one day in time? Theta is very constant until the last 30 days of the option. So you gotta be real careful. You want to protect theta. And so if you're long an option, you know it's going to decline quickly those last 30 days. So you'll probably want to do a trade to capture some of that. But theta is the percentage change to the passage of one day. Vega starts with a V, so that's pretty simple. It's how much does the option price change as your volatility assumption changes. So today, the options on Apple, they could have changed because the strike price changed. Could have changed because interest rates changed. Could have changed because you're one more day closer. Could have changed because the volatility assumption changed. All of those are impacting them. And so rho is the interest rate change, probably the smallest impact of all of them. So there's your delta. I mean, there's your Greeks, delta, gamma, theta, vega, rho. When I traded options with Credit Suisse, that doesn't exist anymore. They got bought out by UBS. I had the best option trader, a guy named Stuart. I don't know where he is today. I called him a few years ago just to catch up. I should have kept in touch. He's from San Antonio, so I keep hoping he'll come home to visit family and come speak to my students. But boy, he knows options backwards and forwards. He sent me an Excel spreadsheet that had all my Greeks in it, so I could look at it, look at all my option trades. I really missed him when he left Credit Suisse because I used to be able to call him up and just talk any strategy. And boy, I had some stupid ones, and he knew in a second. It's like, yeah, that's Ron. That's you're not thinking through this correctly. But every once in a while, I had some great ideas, and he would kind of walk me through it. Smart guy. So if you're an option trader, we talked about you being an oil futures trader. You're an option trader. This stuff's going to become second nature to you. You're just going to know it. It's going to be so second nature to you. So I remember a student. Boy, I got to contact this student. If I can figure out his name, I would contact him. But he went to Dubai. He started his job. He was going to back up their option trader. They wanted someone to learn that guy's job. Sounds like a pretty good job, right? In Dubai, pretty wealthy area. You're an option trader, you got a good career. So he shows up, and the day he shows up, the option trader quit. That's kind of scary. And his boss says, well, we're not hiring anybody, so this is your job now. So how would you like that job? So he was scared to death. And so I talked to him. When I talked to him, he was about as cocky as you could get. So he figured it out. What would you do? Back then, they had something called a Rolodex. Y'all don't know what that is, do you? You know what a Rolodex is? So I would have taken all the contacts for the previous guy, and I would have just started calling investment bankers. Say, hey, John, I saw your name. He's got a lot of notes by you, so he must have called you a lot. I'm the new guy. I don't know what I'm doing. I'll give you every single trade we have if you'll hold my hand and help me the next 3 months. That's probably what I would have done. Just help me through that. But he figured out, and boy, he was so confident. I wish I knew where he is today. He's probably owns the company today. But you can handle it, right? That's the nice thing about this. You have a trader, you're a newbie, they want your business. You have someone to go to. So don't panic, don't freak out. Just start calling people. I'm new to this, what I'm going to do. So I had Stuart at Credit Suisse. Every idea I was just bouncing off of him. And sometimes it was great, sometimes it was bad. We had some really lucky trades. Credit Suisse had this thing where if Ron calls with the trade, we're going to do it because we were just hitting them just perfectly. It had nothing to do with skill. We were just lucky. But yeah, we were doing some trades right at the perfect spot. But I wanted to talk to him and hear and his side of it. So you should be excited about these kind of careers. If you get a career like this, they offer it to you, just take it and learn. You'll learn it somehow. Somehow magically you'll learn it. So if he could handle that job, you know, probably more than likely the person that's training you is not going to quit the day you start. So you'll probably be fine. All right, so here's the formulas we're going to use. The first two you're going to use over and over and over again. So make sure in your notes, you know that this first part right here is the intrinsic value. This is the intrinsic value, not the minus C. That's minus the call price premium. This first part is the intrinsic value. For a put option, it is the intrinsic value. You notice a difference between call and strikes? I mean, calls and puts? What's the only difference in this formula? What was the S? Not the U, what's the S? Underline, what's the X or the K? Strike. So the intrinsic value for a call option is the price of the underlying minus the strike. When we did Apple, we said it was 210 and the strike was 230. What's 210 minus 230? Minus 20, what's the max of minus 20 and 0? 0. If an option is out of the money, what is the intrinsic value? It's 0. All right, so if the current stock price is higher than the strike price, it's in the money, and that's the intrinsic value. If the current stock price is lower than the strike price, that's in the money for a put. So we'll be using this formula over and over again. That's the intrinsic value. So how do you figure out the time value? The time value is just going to be the option premium minus the intrinsic value. Here we're talking about the gain at expiration. So at expiration, your option is going to be worth what the stock price is minus the strike. That's going to be the intrinsic value. That's what you're going to make, but you have to subtract what you paid for the call option. For a put option, if the strike price is higher than the current stock price, that's going to be your gain, but you got to subtract out what you pay for the put. All right, so make sure in your notes, you know this is the intrinsic value. The gain is going to be the intrinsic value at expiration minus what you paid for the option. We're going to do this over and over and again. There's other things you can do. You can combine puts and calls. We'll do that. You can mix long and short positions. We'll do that. You can mix strikes. We're not going to do that, but well, no, we won't do that. Those are called spreads. We won't do spreads in this class. You can mix maturity dates. We're not going to do that because it just makes the math too complicated. You can hold the underline or not hold the underline. So you can hold Apple stock and buy a put option on Apple stock. All right. What's really interesting, one of my favorite theories in finance is called put-call parity. You should look it up in Wikipedia. What put-call parity says is there's two things that have to be equal at expiration. They have to be mathematically. A call option plus a bond must equal the put option plus the stock. It has to. What is this bond? This bond is the present value of the strike price. So if you take a call option plus a bond that equals the present value of the call option of the strike price, and you compare that to a put option plus the underlying stock price, for an at-the-money option, these two have to equal each other. They have to be the exact same price. And if they're not the exact same price, you would buy the cheaper one and short the more expensive one, and you would be guaranteed a profit. You could not lose money because at expiration, these have to equal each other. If you sell this for 102 and you buy this for 100, you make $2 a day, and you know in 3 months they have to equal each other, how much of that trade would you do? For each contract you get $2 a day and it'd be worth 0. How much would you do? 1,000 contracts, 10,000 contracts, how much would you do? I do 7 trillion contracts. I do whatever I could get away with, right? So what does that mean? Well, it also means you can do algebra. That means a call option is nothing more than buying a put, buying a stock, and borrowing money at the strike price of the bond. Or it means buying the stock. You want to buy the stock? You can just sell a put option, buy a call option, and buy a bond that expires at the strike price. That would be the exact same thing. So this is the one most people use. If the stock price is different than this, then you have an arbitrage opportunity. The stock price is 102 and this is 100. You would sell the stock for 102 and you would enter that transaction. You get $2 a day and you know in 3 months it's going to be worth 0. And you make a fortune. This is what we call replication. How do you replicate a stock? You replicate a stock by selling a put, buying a call, and buying a bond. That's called replication. Replication transactions, finance. I can't spell, but Bill Gates can. Option replication theory, replication transactions. I mean, YouTube videos. Someone was asking me, what should I be doing this summer to get ready for investment banking? For investment banking job, I just showed you like 6 videos. And I'm showing the stuff you should be watching. This is the cool stuff. Remember, I gave you option adjusted spread earlier, yield of worst. Here I'm giving you replication, put call parity. I mean, there's so many things you can be watching to expand your universe of terms. It's really, really cool stuff. So what we're going to do is, for the exam, we're going to do a long call and a long put that will be on the exam. And then you'll get one of these 4 things. Protected put, a covered call, a long straddle, or strangle. We'll actually do a strangle and a collar. Now, we're not going to do spreads. On the exam, you don't know which of these 4 you'll get, but you'll get one of these 4. So the next 3 classes, we'll be practicing these, all right? I'm going to set up an Excel, and I'll put the Excel out there on Canvas, but we'll be practicing these, all right? So we'll start there next class. All right. So which one is incorrect? You always have one that's incorrect. Which one's incorrect? Which one? This one? No, this is fine. That's stockholders and bondholders, best before interest. Which one's not correct? Price of book is fine. This is stockholders. That's assets minus debt. That's stockholders. Which one? Enterprise value. So ratio. Bill Gates. Don't give me stuff that doesn't help me. Ratio is in error because EV is stock and bond holders and earnings is only stock holders. What do you do with earnings? It's price to earnings, right? The most popular one. So you don't use enterprise to earnings. All right, so the others are fine. So you can just say ratio is fine.
The thing that enterprise value you get as well.
No. Oh, did I put it in wrong? I'm sorry. I switched them. Sorry. It's a Bill Gates thing. Yeah, so this one's fine. Sorry. Glad you caught that. So yeah, EV the earnings is incorrect. EV the EBITDA, EBIT is fine, but primarily used with tech stocks and firms focused on growth, essentially growth stocks. You would never use price to book for a growth for a tech stock unless it has like Intel has a lot of property, plant, and equipment. All right, price to book ratio is fine, but mainly used for financials, commodity driven firms, and heavy industry. High property plant equipment. So the only we have left is this one. Ratio is fine and the best for a retailer like Target focused on margins. So that's what I'm looking for in your answer, something along those lines. You really, as a finance major, you just got to know this because when you interview, they're just assuming you know these. If you say price to sales, they're going to look at you funny. It's like, why do you say price to sales? You would never say EV to earnings. You would say EV to EBIT or EV to EBITDA. There's some other ones out there. Free cash flow. Do you do price to free cash flow or EV to free cash flow? Well, it depends. You have free cash flow to equity, you have free cash flow to the firm. If it's free cash flow to the firm, you do EV, the free cash flow to the firm, or you do price, the free cash flow to the equity. So there are other ratios out there. These are the only ones the ones we did in class, the only ones I'll show you. All right. Any questions on that? I still think it's going to be the worst question on the exam. Usually the stock valuation is the best question on the exam, and this is the worst for some reason. The options used to be the worst, but students have finally figured out how to answer the options. So, all right. So let's do some options. This is where we're going. On the exam, you'll have to do a long call. You'll have to do a long put, and then you'll do one of these four others. Protected put, covered call, collar, or straddle strangle. It'll probably be a strangle. So this will be on the exam. I'm using real life numbers when we do it. This formula, max S minus X, R, max X minus S. You'll be using that in every one of the formulas, so just get used to that one. And then we'll talk about these others. We'll just do each one as we go. Let's do, boy, Apple reported today, right? How much did the stock market fall today? Oh, it came back. Wow, that's amazing, right? It was down a massive amount. because GDP came out. Why did GDP come out negative? Anybody see that? There's one thing made it negative. So imports, they add exports, they subtract imports. Why are imports so high? People buying ahead of this tariffs. So yeah, it was a strange one. So you look at the numbers, it looks terrible, but it's really not all that terrible. The other thing that was positive for it was inventories. Both of those are temporary things. People are building up inventories because of the tariffs, and they're doing imports because of the tariffs. The inventory brought up GDP a little bit. We looked up the imports. When's the last time imports had that big of a negative impact on GDP? What year would you guess it would be? No, before COVID, well before COVID. So we went back to 1947. We couldn't find a quarter. So one guy did that. That's a lot of power. When you like to be president, you can like, hey, that hasn't happened in 80 years. We don't know before that because we don't have data before that. Some people might think in the, before World War II and the Great Depression with the Hartley Act, whatever that thing was, Smoot-Hartley, that might have caused it. I don't know. But the US used to be the big exporter and then became the big importer. So I doubt even then. So yeah, that was a huge number for imports to be a negative 5% like that. It's just amazing. So we imported a lot. I think the stock market figured out that GDP number was completely useless because it was so distorted by those two. What else? What other number came out today? That was really good news. I'm trying to get y'all to watch. So how can you get this stuff better? We do it in the dashboard team. You just go on the Bloomberg type eco and just go through and look. So the PCE what? Price index, how did it do today? What do they want it to be? Below 2%? What did it do this month, over a month? How about a 0? Does 0 sound good? Zero sounds pretty good, doesn't it? We had no inflation in April. After rising 0.4%, March was terrible. 0.4%, you annualize that times 12, that's pretty close to the 3% that they don't want. They want it 2%. The year over year was only 2.3%. That's pretty good. We're getting pretty close to the 2%. So after a horrible February number, came in pretty good. The core, what does core mean? You take out what? Food and energy. That increased 2.6. Why is the core so much higher? Because energy prices are so low, the headline number is lower because energy prices are low. So when you take energy out, it actually hurts the number. So yeah, if you're interviewing this week, I would certainly want to know what GDP did, why it did it with the imports. I would want to know what the PC, what else happens this week? And if y'all don't get this one, I'm going to be so depressed. What? Someone said it. Jobs report. Thank you. Oh my word, I can keep working. Are y'all watching the jobs report? Will this one be important? Remember, it's a lagging indicator. It's not a future indicator. So the market may not care because it doesn't have really any of the tariff in it yet. But yeah, you have to be, this is your life the next 50 years. If you find it boring, and you can become a music theory major like I was. It's not too late to change majors. All right, so these are the ones we're going to do. So we're going to start, since I didn't look at Apple, let's see if Apple's out there. It should have just reported. Let's look it up. AAPL. I know Microsoft reported. Their stock is flat after hours. Tariff headwinds, obviously. Let's see what Microsoft did. I think they beat, but their stock was kind of flat. I mean, it's kind of the same thing, just down all day and then suddenly jumped up. Maybe they reported after hours. That could be it, that they reported, because when you see something like that, you remember how you can tell if they reported or not? Anybody remember that? You go to historical data, what are you looking for? The volume, yeah. That looks like they reported today. That's a pretty heavy volume. So likely, it's possible tomorrow we'll have to just see. I don't know when the last time they reported. So it's possible it's tomorrow. We'd have to see what tomorrow, if tomorrow's like 80 million or something, or 50 million, that could be it. Let's try Microsoft. So we're gonna do a call option on Microsoft. So it's current price. It's 395. We're just gonna round it off. Leave out the pennies. We're going to go long a call option. So we need a maturity. Let's go out 3 months or so. So you just click on options over here. You pick your date, June, July, August. Let's go out to August. May, June, July, no, July, why, I don't know why I counted. Well, 3.5 months, that's fine. The other thing I like to do before I do that is just look at the stock over this last year. It's been as high as 570 or so. It's been as low as 355. So, if you believe in 200-day moving averages, 100-day moving averages, those kind of things, a lot of times you'll pick that point, maybe at the 50 or 100-day, because if it hits that and goes above, it's probably going to shoot above. And so you're trying to find that point of it. More, if it breaks that, it's going to be going strong. We might try 425. So we'll do August. We'll do 425 strike. And so we need the premium. Which premium do we use, the ask or the bid? The ask, we want the higher number. And if you're not sure on the exam, if you're buying, it's a higher number. If you're selling, it's the lower number. So 425, is that in the money or out of the money? Out of the money, because you went and buy today for that. So, boy, there's not much, there's not a bid number. I don't know why there's not a bid. The bid says 0. I wouldn't sell it for 0, but, so it says 480. The 480 doesn't look correct either. Do I have the right Microsoft? It does say Microsoft, so I'm not sure why. Let's try a different month, because I don't like this. I don't feel comfortable with this. Let's try July. We're getting weird numbers. 425. There we go. That looks, no, that doesn't look right. Yeah, I don't know why we're getting such weird numbers. Microsoft Corporation. Boy, this is just really freaky. Let's try September. There's not a 425. There's a 430. Yeah, I don't like this. Let's maybe, because it's we'll do Qualcomm. So Qualcomm's trading 148.50. Sorry, you'll have to change all your numbers. And this one may not work either. So we'll look at where it's been here recently over the last year. Been as high as 225, it's down to 148. 175 looks like an important spot. Let's try 170. We'll see if this one will work. So August options. 170. Now we got some decent numbers. I really don't know why Microsoft is so wild. So we got 480 and 430. 480 is the ask, 430 is the bids. So we're going to use the ask, 480. At what point will you start making money on this call option? If it goes up to 160, how much do you make? You lose the entire 480. If it goes up to 170, how much do you make? You lose 480. So where do you have to be? 174.80. All right. All right. So the way I'm going to do this, you'll see on the exam, it looks a little different. We'll do a team question next Wednesday, but on Monday, we'll do a little practice with actual exam questions. But let's go to expiration. I make it real simple for you. That's the reason I don't understand why my YouTube on this has 140,000 hits and all these comments, because we're going to expiration. We're making it really, really simple. You don't need the Black-Scholes model. You don't need the binomial model, because at expiration, really important, at expiration, the option premium will equal the intrinsic value. Why? Because time value is what? What is time value at expiration? 0. So we're doing it at expiration. If we did it before expiration, then you're going to look at volatility and all these other factors, interest rates. But at expiration, it's intrinsic value. What is intrinsic value? For call options, real easy. It's the max of what? The stock minus the strike, or the strike minus the stock? Which one's which? One's X minus S, one is S minus X. What is the S minus X, comma 0? The gain is going to be the intrinsic value minus what you paid for the option. All right, so those are the formulas you need. You're going to be using them over and over and over again. That's why students have gotten a little better at this, because it really is the same thing over and over again. So at expiration, let's say the stock price is, I don't know, 130, 135. All we have to say 215. So expiration, let's say in August 2025, Qualcomm is trading for 130 bucks. So what would the stock gain or loss be? Well, the stock, if you bought it today, you would have bought it for 148.50. Well, let's start a little lower. Let's start at 100. Go a little bit higher, maybe 215. All right. So if you bought this stock for 148 and it's now worth 100 bucks, you would have lost $48.50. That's pretty straightforward. And that just goes forward. It's just a diagonal line. As the stock price goes up, you make money. So at expiration, the stock price fell 48.50, then you would have fell to 100, you would have lost 48.50. What about the call gain or loss? Well, the call gain or loss is going to be max S minus X, comma 0 minus the call premium. The first part is the intrinsic value, so it's the intrinsic value minus the call. So here we're going to do equal max $100 minus what? The strike, 170. What's that going to equal? 100 minus 170, that's negative 70. What's the max of that in 0? Should be 0. And so what are we going to do if that happens? We'll lose the 480. So it's going to be 480. At what point did they start making money? 170, 480. That's where you're exactly at 0. If I graph the call option, what sport apparatus is it going to look like? That we don't play in Texas. Like a hockey stick, exactly. Really big hockey stick, but that's the hockey stick. It's bullish, so it goes up when the stock goes up. The put option is going to be bearish. It's going to go up when the stock falls, but that's a call option. Remember this when we talked about put call parity before. You're going to see this picture again, and you're going to see why when we talk about put call parity. We're going to see almost exactly the same graph again. All right, so that's what a call option looks like. If you combine the stock and the call option. The stock is just a diagonal line. The call option, the worst you can do is lose $4.80. It looks like you're making much less money here, but here you had to invest $148.50. Here you only had to invest $4.80. So here your loss is 100%, but it's only $4.80. Here your gain is several thousand percent, whereas here your gain is much smaller. So you can see how the option, it protects you on the downside. The upside, you don't make as much in dollars, but your percentage return is much more massive because you only invested $4.80, right? So that's what we call a long call option. I'm not going to do the legend because it takes too long. All right, that's a long call option. The stock is just a diagonal line. The call option has this hockey stick to it. Questions on the call option? If you know these formulas, this problem really is a piece of cake. All right, well, let's try it again, but this time let's do a put option. So we'll do Qualcomm again. Just keep it simple. We'll do a put option. Maturity, again, we'll do August. And a strike. So let's go back and look. So here you're worried about Qualcomm falling. We look at their stock price and look at that 125. If they break through 125, they're going. Right? Y'all know the concept of resistance and support. So 125 could be support. It might hit 125 and bounce off of it, but if it breaks through 125, it's probably heading out. Some people might do a diagonal line down. It's kind of hard to do a diagonal line on this one. But let's say 125, because your thought is, hey, it could fall to 125, but if it falls to 125 and breaks through, it's going for the seller. So we'll do a strike at 125. And so our premium, again, it's going to be the ask because we're buying the put option. We're long put options. We'll see if 125 is available in August. Sometimes the further out you go, you don't get the fives, you only get the so 125. It's out of the money, that's why it's in the blue. Pretty wide bid ask, so that makes me a little nervous, but 2605. Why is it so expensive versus the call? It's really hard to say in this one. I'm wondering if I have the right. So the stock is trading for 148. Yeah, there's something wrong with this chart. What is going on with Yahoo Finance? This one looks right? The switch between out of the money and any money is 135. What do y'all know is the problem with the puts? Is the blue line in the right place? So I don't know what I usually blame Bill Gates, but I don't know if I can blame him. So let's try July and see if that fixes it. That looks better, doesn't it? Or I guess it's 150. It should be at. Wait, let me go back. Boy, this is getting really confusing. No, that is correct. Okay, it's correct now. Then we're back in August. Yeah, I don't know what happened. All right. So sorry, we'll stick it with August. All right, so 125. If 170, that's kind of interesting, isn't it? They're both 480. Is that just coincidence? I didn't plan it like that. So 480. That 26 didn't make sense to me. So in my mind thinking about it while I was asking you the question that I would come up with an answer, and I'm like, it doesn't make sense to me. So they should be about the same because they're both about the same out of the money. So it's not quite parallel because when stocks pay dividends, it benefits the put options. So usually the call options are a little bit cheaper than the put options. But yeah, that didn't make sense to me. So 480 for 125 strike. And so at expiration, we'll do the same thing we did before. We'll start at 100. So the stock gain or loss is going to be the same. The put option. Again, it's the intrinsic value minus the option premium. Remember, for our put option, the intrinsic value equals the max of X minus S this time, and 0. And then that minus the option premium. So here we do equal max 100 minus 125, comma 0. What's that going to give you? 25, positive number, right? Oh, I did it backwards. Oh, you're already paying attention. The max of the strike minus the stock, comma 0 should give you 25, right? Because the stock price fell. That's your good news. Did you make 25 bucks? No, because you paid 480. What's your break even on this? If the stock falls to 130, what do? You lose $4.80. If it falls to 125, what do? You lose $4.80. Where do you start making? When do you make your money back? 120.20, right? $120.2, you exactly break even. Why? Because when you hit 125, you start making money. At 124, you make $1, but you paid 480. So 125 minus 480 is 120.2. Once you hit 120.2, you'll start making money. All right. So what is this going to look like? It's going to look like a really short hockey stick. Or a really long hockey stick, I guess. The handle is too short, but it's the same concept. If we combine that with the stock price, you see it's a bearish. It makes money when the stock price falls. But again, it looks like a hockey stick somewhat. It's just a really, really short hockey stick. The worst you can do is lose $4.80. If the stock price goes up, you're pretty upset that you did that, but that's the analysis. These two will definitely be on the exam. I'll show you how it looks on the exam. Actually, this weekend, you should, for prepping for the team question, you should probably watch the video. The video walks you through it real carefully so you can see exactly how to do it. And the call and the put will definitely be on the exam, so definitely watch out for those two. All right, so then what are we going to do? So let's look at this and see if we can kind of start memorizing this. So a long call is the max of S minus X. And then you have the call premium. Long put is the max of X minus S. And you got the premium. So what we're going to do after this is combine things. The protected put, we're buying the stock and we're buying the put. All right, a protected put, you're long on the stock and you're long on the put. The second one, covered calls, you're long on the stock and you're short on the call. All right, you buy the stock and you sell the call. A collar is like combining these two together. A collar, you own the stock, you own the put, and you short the call. We did a lot of collars at USAA. It's kind of a nice strategy. On the strangle or straddles, you don't own the stock at all. You own a put, you own a call. Now you can go short a strangle, then you would sell the put, sell the call. That's like if you really want to risk the entire all your wealth. That's really dangerous. Most people don't do short strangles. They'll do iron condors or butterflies or whatever. They'll usually take the tails off. You can go out there and go look at most popular option strategies. Here's Investopedia. Theirs isn't too bad. So covered call, all this stuff comes up. I don't want that. I don't know how to get rid of it. There it is. Covered call. They don't have a picture. They do have a picture, so we'll see a covered call. Married put is kind of, yeah, we won't talk about a married put. We won't do spreads on here, but spread, what are you doing is you're buying a call and you're selling a call. So you might buy a call at, or you might sell a call at 270 and sell at 270 and buy one at 300. So if you sell at 270, you have unlimited loss, but if you buy it again at 300, you prevent yourself from losing too much. Spreads are pretty good. We did some spreads when I was at USAA. I might tell you about my most stressful day, like my most stressful 20 minutes at USAA involved a put spread. It was really, really, really stressful. There's a bear spread, protective collar. Well, someone will talk about that. We'll see that. Since we don't call it a protected collar, we just call it a collar because that's really what it is. A long straddle. It looks like the letter V, as well as we'll see a straddle. We're not going to actually do a straddle. We're going to do a strangle, which looks more like a V, but with a bottom to it. Strangle. So we're going to do something that looks more like a strangle. So it has a bottom to it. So the straddle is really hard to do because the put and the call have to be exactly at the money, which is really hard to do because of the stock's trading for 149.80. There is no option trading, strike with 149.80. So we'll probably do that. Here's the butterfly. So a butterfly is you're essentially selling a strangle. So you get the V, but the V, instead of being unlimited loss, it just keeps going down. What you do with the butterfly is you cut the tails off. So you make a lot of money if the stock doesn't move much, but with the strangle, the straddle, with this one, it's a V. If you sell it upside down, you essentially have unlimited loss. Most people don't like that. So with the butterfly, I really like the butterfly. It's kind of cool. You have a really high probability of a gain. You have a loss, but at least you've limited your loss. So you can't just go completely out. Iron condor, very similar to the butterfly, where you're trying to limit that downside by expanding. And then you can our butterfly again. That one looks too good to be true, but you'll discover these things or when you actually run the numbers. So those are all popular ones. We're not going to do anything with the word iron in it, or butterfly, or condor in it. I don't know how these times. I don't know if they named these because I thought this looked like a condor flying. Maybe I don't know if that's an airplane or a bird. I don't know who gets to name these. What I want is for some UTSA student to name one of these so that we can have some naming pride here. So y'all come up with one. So we're going to do protected put, long a put, long a stock, long a put, covered call, long a stock, short a call, collars, long to stock, long to put, short to call, and then straddles, strangles, your long to put and the call. That's the only 4 you have on the exam. Do you have to memorize those? No, don't memorize them. You should just know them. Your finance majors, those are the 4 basic ones. You should just know them. All right. So let's start off with a protected put. You're going to discover very quickly that the protected put looks like something we've already done. So let's do it. It's pretty cool here. Let's bring in the put option here that we did before. So with the protected put, We've already done it. With the protected put, we're going to own the stock and we're going to own the option. Which means what? The protective put gain or loss is going to be what? You just add the two columns together. Pretty simple, right? You do the put, you just add the put to the gain on the stock. What do you think your loss is going to do as we go up? You may discover that this number doesn't change a whole lot. Why doesn't it change? Because once you hit 125, every dollar you lose on the stock, you make that dollar on the put. So at some point, the put just stops your losses. So what's the most you can lose in this? What if this stock went down to 20 cents? What would be your loss over here? 28.30. So that's what the protected put does, is it gives you a floor just like insurance. And then as the stock price goes up, you start making money. Where do you start making money? Well, it's very, very similar as before. You start at 148. You've got to make the 148 plus the stock needs to go up the $4.80. So at 153.30, you're going to have a zero loss because the stock's going to go up $4.80, cover your put option. All right, so what sporting apparatus is this going to look like? Tell me if you've seen this before. Does that look familiar? Didn't it look a lot like the long call? And why is that? Remember, put call parity. A call plus the bond equals the stock plus the put. What is the protected put? Isn't it the stock plus the put? The bond you can kind of ignore. So the call option, long call option, looks a lot like the protected put. They're practically identical. So there you got that put call parity. So essentially you're saying a call will have a very similar payout pattern to a protected put. Well, I'm not going to say long protected put because there's not a short protected put. So again, it looks like a hockey stick, very, very similar to the call option. Depending on what numbers I started with. So the protected put's really, really simple because you've already done it. You just got to figure out the gain on the stock. So all you got to do with the gain in stock, what was your starting price minus what the ending price is. That difference is going to be a gain or loss on the stock. You do the put option just like you did for the put. Just add the two together, you've got it. Why do you want to do a protected put? Well, you're worried about the stock falling. So you say, well, why don't I just sell it? Well, why might you not want to sell a stock? It was April 15th a few weeks ago. Why would you want to sell a stock? Tax gains. So you have a client come in and says, okay, I've held Apple stock for years. I've got this massive $80,000 or $8 million, whatever gain. If I'm really worried about Apple, I think it could fall. I think it's overpriced. But if I sell, man, I'm going to have all these tax gains. You say, well, I'll tell you what we can do. We'll buy a protected put. It's going to cost you a little bit, but a lot less than your tax hit would be. If it falls, then the most you can lose is $28.30. But if it rises, so this is Qualcomm, if it rises, you'll make as much money as before, but you'll be off $4.80. So that's the protected put. So if you don't want to have to sell the stock, a protected put's not a bad way to go. It is an expensive insurance. That $4.80, if you think about it, You take that as percentage of the stock price. This is over the next 3 months, you're taking 3% away from your gain. That's pretty expensive for 3 months. Or 4 months, whatever it is, 3.5 months. So that's pretty expensive. So you probably don't want to do this too much. We're going to talk about the collar might be the better way to go. All right. Questions on protected puts? The next one is the covered call. Anybody remember the covered call? We just talked about it. So protected put, you own the stock, you own the put. Covered call, you what? Own the stock and sell the call. All right. Covered call. So we'll go back to the call option. Copy that over. I got to make one big adjustment right here. What do I have to change this to? If I'm selling the call, got to be the bid. That's the only thing in the exam you got to be really careful of. On the exam, I give you the bid and the ask. You just, I don't know when to use which one. So if we look at Qualcomm, I still have August. All right, so here we're looking for, instead of 480, it's going to be 430. And so in this case, we don't add them together. We own the stock, but when you short something, what do? You subtract it. So this is really important. When you're doing the gain or loss here, the intrinsic value, what you do, a lot of students miss this. How do you figure this out? So the gain on the short call, you're going to set it up just like you do a long call. You're going to do max S minus X, 0 minus the option premium, except for you're going to use bid instead of ask. What's the only thing you need to do with that? You calculate that and you take that entire thing and change the sign. Go positive to a negative or a negative to positive. All right. Because you're selling the column. So the formula is exactly the same. You do the entire formula. Don't just do the intrinsic value, do the intrinsic value and the call option. Do the entire formula. Just use bid instead of ask. Just do bid instead of ask, but the formula is exactly the same except for that change in premium. So since we're using bid here, I've already have it set up. Now, what is this going to look like? I don't know what it looks like. It's just a weird shape, but maybe it's an upside down hockey stick, maybe. So this is a covered call. Why in the world would you do this? Well, can make sense, and we'll talk. Well, here's how I would use this. Let's say you own Qualcomm and you run an analysis and you think your target price is 170. So you say, hey, if Qualcomm goes to 170, we're going to sell it. Well, you can wait till it hits 170, but it may never hit 170. What else could you do? Well, you could sell a call option with a strike of 170. If it hits 170, you essentially have sold the stock, right? That's once it hits 170, it's going to be like you sold the stock, because any gain on the stock is going to be an offset loss. Well, what happens in this case? Let's say you sell this call option for 430, and let's say the stock never hits 170. Are you better off or worse off? Aren't you a whole lot better off? You got an extra $4.30. So where I love covered calls is you have a target price, you're convinced you're gonna sell the stock when it hits that price. Don't wait till it hits that price. Sell it now by selling the call option. If it never hits the price, you get to keep $4.30. That's all your money. That's wonderful. If it hits 171, 172, 173, it's just as if you sold it at 170, which you wanted to do anyway. So you're good. The only time this doesn't work is if it closes, let's say at 169 and opens the next day at 178. If you do this, you're going to be selling it at 170. Whereas if you don't do this, you'll get to sell it at 178. So where this really hurts you is what we call a discontinuous market. When the closing price is much different than the open price, this strategy can definitely hurt you because you're stuck with that 170. There's no way you're going to get around that. So this is pretty rare. It can happen, but it's pretty rare. So you do have to watch for that. We're seeing like with Microsoft and Apple, when they're reporting earnings after hours, that can be really risky. So you probably don't want to do this if it expires the day of earnings release, because then you're in a lot of risk for this discontinuous market. But I like covered calls. Unfortunately, with our portfolio for UTSA, they're not allowing us to do this, but I would certainly do it. Have a target price. We put in the call option, sell the call option. Other schools get to do it, which is kind of irritating that we don't. I saw, I think it was Baylor University gets to do these transactions. There is another way you can do that as well with put options. Let's talk about put options. You want, so let's say our target price is 125. We loved Qualcomm, but it's too expensive. But hey, if it hits 125, we want to buy it. So what can you do? You can wait till it falls to 125 and buy it. What else could you do? You could sell a put option. You sell the put option at strike at 125. What happens if it hits 125? You essentially have bought the stock. What happens if it never hits 125? You get to keep that premium. So I like covered calls. If you have a stock that you're definitely going to sell at a price, go ahead and sell it now by selling a call option at that strike. Or put options, you don't own the stock, but you do want to own it. If the stock price falls to a certain amount, go ahead and buy it now by selling the put option today at that strike. You're essentially buying it now, but you get to keep the option premium. They're really, really good strategies. We can't do either one of those in our portfolios. It's kind of irritating. They're not letting us do that, but you in your personal portfolio, you can definitely do that. So get target prices. Once you have a target price, start buying and selling options and add that to your return. It adds quite a bit to your return. You know, here we're talking about, oops. Adding almost 3% to your return just in 3 months. That's pretty huge. So if it hits 170, you buy it at 170 with the call option and you end up with an extra $4.30. It's kind of wonderful. So that's the covered call. So cover call, you own the stock, you sell the call options. So here you got to take the stock minus the call option. Since this is a minus, this is helping you. It reduces your loss. But at some point, you can't go any higher. Why? Because once you hit 170, every dollar you make on the stock, you lose $1 on the call option. So once you hit 170, you can't make money anymore. You still get the $4.30, but most you can make is $25.80. Where's that $25.80 come from? Well, you got 170 minus 148.50. So you make $21.50 on the stock. What else do you make? You make the $4.30. So $25.80, that's the most you can do. All right. What's the worst you can do? Well, on the call premium, you always get the call premium. That's always yours. That $4.30 is yours. So you're always going to be better off from that standpoint. you can lose everything, right? There's no limit here. This thing can go down. So if it goes to zero, you get to keep the $4.30. So, you know, the call option always there is to keep, so that's kind of nice, but there's really no limit. Most people don't like this shape because it's my word, you're just losses, but you can see how it makes a lot of sense to add value to your portfolio. So let's combine those two and do a collar. So we used to do collars, but we did collars with spreads, so it's a little bit different. I don't know what that's even called. I don't think there's a term for it. So essentially what we're going to do, we're going to take this protected put that we already have built. We're going to bring in our call option. Sorry, I'm not sure what Bill Gates is asking there. And then bring in our short call. So with the collar, we're going to buy the stock. We're going to buy the put, so we use the ask price. We're going to sell the call, so we use the bid. So when we do that at expiration, here's the stock. The put we still need. We now need the call option, gain or loss. Again, remember on this, we're selling the call, right? So you're still going to do equal max the stock price minus the strike price, comma 0. That's going to be 0, right? You're not going to do that. Minus premium. But here we're shorting the call, so what do we have to do? Put a minus sign in front of that entire thing. So instead of being negative 430, it's going to be positive 430. So what is the collar? You just add those together. You have the stock. It lost you $48.50, but the put option saved you. Plus you get some call premium. You still lost 24 bucks. You notice that 24 bucks is the same. At the top, you lost $4.80 on the put option because the stock price went up. And on the call, you're losing a lot of money, but that's offset because the stock's making you money. So at one point, you only make $21. Why is that? Well, at the bottom, the stock fell $48.50. So you have 100 minus 148.50. You lose that, but the call option, the put option is giving you the 125, so you get that 23.50. You're going to lose that for sure, but after once you hits that, you just lose $4.80. So you can fall 23.50 plus another 480, 27.30 or something. But then the put option after you hit 125 starts helping you. I'm not going to do the math on that. So the put option's helping you, but it only starts helping you at 125. So you get the full loss from 148 to 125, plus you lose $4.80. The call option helps you on the downside because there you get to keep the premium, the $4.30. It doesn't help you much, but you know for sure the most you can lose is 24 bucks on this. But you also know the most you can gain is 21. What does this look like? Again, I don't know what this is. Just a kind of a freaky, probably the freakiest one of all. Oh, that's a collar. Now, USA, we did collars with put spreads. So we got a few minutes, so I'll tell you my most stressful day. So we actually did a put spread. Why do we do a put spread? So we bought this put at 125, but then we sold a put at like 115 or 110. What that means is that the stock fell to 125, we were protected. But if it fell to 110, we were losing money again. Why do we do that? Because it's really expensive to buy these puts. So if you buy a put at 480, you can sell another put at say 203 and you cut that cost in half. But now if the stock falls to 110, you're going to start falling again. So my most stressful day at USAA, we had this put spread and I looked at my computer screen. We're good at that. We were below, I don't know what the exact numbers here, but using this, we're below 125, but we're above the 110. So it was protecting us and we're like maybe in the 120 range. So we're well above here. So I'm worried about if we fall below that, I'm in trouble. I'm going to start losing money, but we're at least protected. So as we fall below 125, protected. And then the stock market started going crazy. So I call my broker and say, you know what? I just want to buy this back. I just want to take that bottom spread. I'm just worried about the market crashing. While I was talking to him, the market settled down. Said, oh, forget it. I'm fine. I hang up, the market goes crazy again. So I call him. I say, you know what? I just want to buy that put. Market's going crazy. It settled down while I was talking to him. I said, forget it. Third time I call him. Okay, you know, this time I'm sure I want to buy it back. Because we're talking, you know, a few $100 million. The market crashes. And so I'm kind of, you know, $300 million, that's more than they pay me. So I'm thinking, you know, I got to get out of this thing. So I tell him that, I hang up, and it felt like to me 3 seconds later, the market crashed. And I'm thinking, there's no way he got that trade. My heart rate was like 280. I don't know, whatever the max heart rate is before a massive heart attack, I was 1 beat below that. And so I'm thinking there's no way he could have gotten that trade in. It was a pretty big trade. So the phone rings. It wasn't Stewart, the guy who took his place, unfortunately. Stewart would have had me much calmer. And his voice didn't sound good. He goes, Ron. It's like, that doesn't sound good. I'm thinking he's going to say, I couldn't get the trade in time. Sorry. But he goes, Ron, boy, we got that in just in time before the market crashed. I literally got up and laid down on the floor until my heart rate would come back down, because that saved us a few $100 million. I mean, it was massive. So yeah, just pure luck. But boy, I had that guy stressed out too. But that was incredible stress. That's why I don't like managing other people's money. It's just so stressful. The guy who works with me, he wasn't in the office, so he comes home. He comes back, and he's like, "Well, you see what happened today? We're in a lot of trouble, aren't we? Man, that thing just went right through the bottom of our spread." I go, "No, we bought it back." So he's like laying on the floor. So these things are very, very volatile. In 2008, yeah, it was a horrible time to do. So we were hedging, so it was really good. How did a hedge work? Well, one of my pride and joys is this. So those are my risk class, already saw this, but there's my CEO. He passed away this last year or 2 years ago. Joe Robles, liked him a lot, great guy. Worked with him a long time on many projects. But this is my portfolio. Why can I be proud of a 1% return? Because the market was down 37%. If I had not done that trade on that day, this would probably been a negative 3 or 4%. I mean, it would have been much further down. So, I mean, it wasn't a huge portfolio, but you know, it's a sizable portfolio. So we made 1%. We were negative on December 30th. The market was up 1.3% on December 31st. So we went from a slightly negative to a positive. My boss said, you better get a positive return. I was like, you know, give me a break. So, all right. So this is what the exam's going to be. So I don't know if we have guests here. That's interesting. Those two guys make me nervous, but all right. So y'all tell me now. A protected put is what? Don't look at your notes. Every finance major knows this. Buy the stock, buy the put. The best way to say it is long the stock, long the put. A covered call is what? Long to stock, short to put, the call. So protected put is usually long to stock and long and out of the money put, usually. A covered call is usually long to stock and short and out of the money call. All right, what's a collar? What's a collar? Y'all know collar? I just said combine the two of those things. So what would that be? Long the stock, long what? Put out of the money and short the call out of the money. All right. So what's a straddle or a strangle? You're long two things, long the put, long the call. There's no stocks on the strangle. And condors and butterflies, Josh probably knows all of those. What are other what's the wildest one you can think of? They all have these names. So I challenge them to come up with a new option strategy that they name it and it's permanently in that name. All right, so next Wednesday, well, Monday, I'm going to show you exam questions so you can see how it's structured. Because you don't have Excel. I wish we had Excel. We could do a lot better exam questions. We'll see how it's structured. We got to finish up the strangles and the straddles, or really the strangles. We'll figure that, and I'll show you some exam questions as well. All right, any questions, anything?